This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
My guest today is Mike Dever. Mike was actually the first interview to appear on this podcast. Mike has a quant understanding of the world. He has a trend-following understanding of the world. He's got a very reasonable, rational, thoughtful understanding of the world. And I always like having him on. If you want to check Mike out, you can find him at his firm, Brandywine. Been around for a long time, managing money for clients. I got to tell you, one of the things that I love with this podcast, and it will never stop, when it comes to good conversations, it's the traders. The traders bring the game. The traders bring the understanding. Yes, I've enjoyed talking to a lot of different people on this podcast, some brilliant people on this podcast, some great entrepreneurs, some Nobel Prize winners, but it's the traders. The traders are the ones that make you go, yes. Without any further delay from me, I hope you enjoy this conversation with Mike Dever. When I look at certain markets and I see these moves that have happened in 2024, I mean, these are the kinds of moves that you've seen many times in a 4+ decade career, right? These things happen, these near vertical moves up. For those people, there's always a new audience coming into the investing world. They think that they've got the piece of information they've got figured out. They know something fundamentally that's this time is different and all that kind of stuff. How do you feel when you see some of these near vertical moves across tech stocks and crypto right now? What's your first feel, given the context of your career and the time frame at which you have had a chance to analyze things over all this time?
So actually have commodity moves right now. You got cocoa going 4 or 5x off as low as 2 years ago. The speculative markets will always exist. I made a comment in December of 2022. We haven't retraced from that much. That this was the most speculative environment that I have actually ever seen in my history. And I started out with a gold bubble. And
Hold on, you mean right now?
well, I said that in 2022. We had some correction to that. But just like it seems over the last 20 years, every time we've had a correction, it's come back with the markets getting even more exuberant, more speculative in the following cycle, and just reinforcing people's behavior that the best thing they could have ever done was not to sell into the panic and to continue just to buy into the panic. In 2022, my comment, it's kind of re-happening, right? It's still holding up. It was the most speculative environment because of everything that was happening. We had real estate going crazy in pricing. We had stocks going crazy. We had tech. We had concentration in tech. Stocks that were going crazy. We had SPACs, where people were just rolling out companies with no purpose to exist that were getting multi-billion-dollar valuations. We had that in venture capital and startup valuations of companies. We had it certainly in crypto. We had it in NFTs. My wife's question at the time was, what is an NFT? And I said, an NFT is the right for you able to say that you paid for something that everybody else can get for free. Anybody could have downloaded Banksy's art and put it on their desktop, but somebody paid $69 million for it to say he had the original of digital art. There is no original. It's all the same, replicated the exact pixel. What we had was a correction from that. So it was 2021 when I was saying that. So you had 2022 where you had a correction from that. And then very quickly, everybody started realizing that, okay, it's an opportunity again. Let's jump back in. Now you've got crypto back to new highs. You've got these tech stocks and the Mag 7, Mag 6 maybe that are making new highs. Things are going crazy again and speculative juices are flowing. I think we just keep accelerating the cycle.
It's an interesting word that you use there, the second time you've used it, and I should let you clarify because you come at this from a quant approach, a trend approach. I do too. And so when you use the word cycle, I should let you clarify.
I don't mean cycle in the sense like when I started in the business 40 plus years ago, Walter Bressert was a psychoanalyst and everything was down to overlapping a 9-week cycle or a 6-week cycle or a presidential cycle. He was trying to explain price movement with precision based on cycles and overlapping. I don't believe that at all. I don't think there's any really preset rhythm that you can sit there and identify and determine that, okay, Kondratiev wave is going to take hold now. What I mean, I guess, is more of a psychological flow that occurs and it doesn't occur necessarily on a regular basis. It's on its own time cycle, but it does continue to recur. And what we've been having is a sort of an increasingly positive, from a speculative standpoint, recurrence of market manias, where people are, every time that it comes back from the dead or from the bear market, they're reinforced even further that their proper decision was not to sell into the panic and to buy into it and to push valuations to higher levels than you've ever seen before.
We are both not trying to come at this from a fundamental perspective, but there's a particular fundamental that I want to mention because I think it's interesting. If we look at these bubbles that form, bubbles that pop, .com forms, .com pops, Great Recession happens, Great Recession pops. From that time, the Great Recession time, watching crypto come alive, we had very low interest rates, almost nothing, right? It is fascinating right now to watch this speculative fever unfold while rates are not exactly low.
Right. That's true. This is unusual over the last 15 years, where there are arguments out the wazoo about the reason that we were getting these speculative bursts, and it was due to artificially low interest rates. And you can't make that argument now, and it's still happening. And I think that just shows the power of psychology and the power of the crowd. It doesn't really matter what the underlying conditions necessarily are from a fundamental standpoint. If psychologically people are in a mania, or people want to buy, or people want to believe that if they do something, that it's going to reward them. If they continue to see that reward happening over and over again, crypto hitting new highs, and they're going to continue to be reinforced in their behavior. And it doesn't matter what that underlying fundamental is. And that really is the description of bubbles. It's market price action that's disjointed from the actual underlying fundamentals. The underlying fundamentals are what drives it. It's purely internal. It's a psyche internalized move.
So I was around a group of Western men recently, many of which have had Bitcoin positions for 10 years, some guys that have made some nice gains. And I was challenging them a little because there were so many fundamentals being discussed at the table. And I respect the people, respect their views, but I was kind of like gently nudging. There was a lot of talk of cycles, why Bitcoin has gone up recently. I just said to him, I said, hey guys, you guys have been around for a while. Do you really think you've got a fundamental narrative that can explain the price action of Bitcoin since inception? I mean, it's not been a straight line up. It's been a major roller coaster. And I just think you're welcome to expand on this. There are very few techniques in the investing world that can trade the price action of Bitcoin since inception. And I don't think fundamental analysis is one of them.
Right. It's not. I've long stated that Bitcoin is the most speculative market in history. You can go back to Tulip Mania even. I say that like in a pure speculative market. People have tried to argue fundamental reasons for Bitcoin to exist and to have a purpose. It's gone from being an alternative currency to being a medium exchange type currency to being a gold substitute. It's none of those. The reason I say it's perfect speculative market, it's designed to be constrained in its size. Couple that with the fact that a lot of it's been lost. People, once they lose their key, they have no way to reaccess. So you've got this limited supply, and of course, the recent halving again, that if you have any kind of increase in demand at all, and you almost don't need an increase in demand, you just need it to continue to have some demand that's less than the amount of supply that keeps coming on, you're going to have market go up in price. It's like a classic chain ladder. As long as there's more people that want to own it at the margin, the price is going to skyrocket. And it can go not to infinity, but it can go substantially higher just because there's no constraint on it from a fundamental standpoint. That's the beauty of a purely speculative market like Bitcoin. And it's like the .com, right? In .com, there were no constraints on what you would pay for some of those companies that came out because there was no metric that they were really measuring them by. They tried to invent metrics like eyeballs to justify the price that was already in the market. And that's where we are with Bitcoin.
But this is, just to be clear for people, you're not giving that explanation to throw cold water necessarily. You're not saying it is a negative. You're just pointing out, matter of factly, it's a speculative market, which means if you've got a certain rule set and you know it's a speculative market and you know price action perhaps is the only way to trade it, that's not necessarily a bad thing. A lot of money can be made.
Absolutely. Yeah.
Yeah, I just want you to clarify that you're not saying something negative about Bitcoin. You're just pointing out that the fundamental part of it, people's desires to explain why Bitcoin is doing what it's doing. Every time I hear one of these explanations, even from people that have made a lot of money, when they're saying it, I almost think they know they're saying bullshit too.
Yeah. I bought, so FTX collapse, all this hit the fan a year and a half ago. We bought Bitcoin using GBTC when it was under 16,000. The reason we bought GBTC because it was traded at a discount of over 40%. My family bought it. My partner bought it. We bought it in one of our funds. It was one of those situations where I just looked at it and thought, okay, we got a potential asymmetric price return on this thing. Just like any market, when you see it massively, massively depressed and people abandoning it, well, okay, that's probably when you want to buy it. What was the best way to get into it then? Not by buying Bitcoin, but buying GBTC, because now I was getting the Bitcoin price at a 40% discount. So we were buying it at under 10, between 8, 9, and 12, GBTC. You're up over 70, right? I'm sitting there thinking Bitcoin is this greatest thing in the world and a great company. I just looked at it as a market that was beat to crap. Potentially had a upside to it that was bigger than the downside. There was no fundamental reason to that at all. It was all psychological, purely psychological.
What we're seeing right now in terms of that price action, we can look at other equities, for example, NVIDIA. Obviously, Bitcoin's not a company, but there are companies out there that have similar price action. I think it's worth addressing is many, many investors are concentrated in a handful of, let's just say, opportunities with their gains. And this can be in a dicey place to sit. Someone shared with me recently, they bought NVIDIA under 100 and where it is today. But I'm almost positive this individual did not have a stop in place ready for anything. You could see with their understanding of how it got from under 100 to 1,000, they didn't know. Obviously, anybody would be happy in that situation. But it's also a dangerous place to be because if you don't know, if you don't really have a plan, these things can get retraced. And we saw this from 2000 to 2002. Plenty of people had massive gains who became footnotes in history because the simple act of not having a stop.
I won't want to say interview because it wasn't intentional an interview, but in my book over a decade ago, I had a woman that came to me that had $10,000 account in the .com boom, ran it up to 3 million in a matter of 18 months, maybe, and ended up being margin called out of it back around $10,000, maybe 6 months later. Total round trip. The issue, I'm always early out. It's just, I see these moves. If I don't have a fully quantitative, systematic process in place, psychologically, I get out a 10 bagger. It's like, wow, this is crazy. But the real moves happen, the real wealth happened in these moves where you get things like NVIDIA that goes crazy or Tesla or Bitcoin, and people just continue to ride it. The problem, as you point out, is they ride it because they just have total faith in it. The reason that they're riding it up as high as they did is because there were plenty of opportunities prior to that to get shaken out. And they just had this total belief that it was going to go higher. They didn't.
That notion of total belief, it's just wild There's always going to be a new generation of investors walking into the market. That new generation is always going to have a different historical perspective. Total belief. I see it. You see it. You've seen it forever. It's an amazing concept. Right now, if I had to draw a parallel, and parallels are silly, frankly, because history sometimes rhymes, but it very rarely is similar. But I would have to say, in my limited time, the only parallel I can draw to the euphoria that I'm hearing from people right now would be in 1999, when the NASDAQ went up 100%. There was just unlimited euphoria. How do you bring people into that mindset? Is it possible that when people are in total belief to bring them out of it? I almost don't think it is. It's almost like a cult. They've made so much money on paper. I mean, paper's real money, but they've done so well that it doesn't matter. Anything you say might be in their mind categorized as, well, you didn't do as well as me, or you think you know better than me, but I've got the profits here. Once you take a look at these large historical moves over time, equities, commodities, etc., this human passion, this human euphoria, it's just plain normal. It happens over and over again, and it all seems to end the same way.
Yes, it does. If people didn't have that total conviction, they wouldn't have held on to the GameStops, the meme stocks when they were going up 50-fold, when they were already coming from a base that was not supported by fundamentals. They wouldn't be riding Bitcoin through multiple 60, 70, 80% crashes if they didn't believe that ultimately it was a $1 million plus. And what you'll see in all these moves is that target continues to move. 10,000 was a big Bitcoin number, and then the 50,000, 100,000. Now you're regularly hearing $1 million now for Bitcoin. So that target continues to move. And what happens is their behavior gets reinforced every time that market falls and then comes back to a new high, whether it's a tech stock or a meme stock or a real estate market or a commodity. Think back on the Jim Rogers 2000s commodity boom and people that got on board with that. And everybody kept raising their targets of where they thought commodity prices were going to go. They didn't end up there. I don't know where Jim ended up on that, but ultimately people are believers and that's what helps drive it. But they get reinforced in that behavior when it works. Somebody told me years ago, this is just so real, is that it's not the magnitude of a decline that shakes people out. It's the length of the decline that shakes people out. It's the duration. You need to have something like you had in the 2000s, where you had multiple bear markets. You went a decade where people did not make money in stocks, even with dividends reinvested. For people to finally capitulate and to bring down valuations on fundamentally based assets like stocks or real estate to levels where it makes sense to be buying those again. And at below the price where it makes sense to be buying those again, 20%, 30% below those prices.
To share too, just so those crypto folks out there don't think I have got just some kind of bias here. I saw a guy the other day, well-known handle on X, formerly Twitter, and he had the comment that Bitcoin would be at 5,000 by 2025. And that's the same thing in reverse. He doesn't have any more knowledge of Bitcoin going to 5,000 in 2025 than you or I do to say that Bitcoin's going to go to 1 million in 2025. No one knows.
That's right. That's why I say it's the most pure speculative market that I've ever seen, because there is no underlying fundamental for where it should be or why it should be there. It's just purely psychology of the crowd and the people that are at the margin playing in Bitcoin. That's what's going to drive the price. This is one where I think the only way to trade a market like that is with something like a purely technical trend following approach, where you're just systematically saying, hey, I'm in here or I'm out of here. That's it. You're using some sort of a trends approach to it.
Let me put something practical on the table. I kind of brought it up a second ago, but we've got these handful of tech stock positions, crypto positions, a relatively small number of markets or companies driving such huge gains in overall markets. But we also have the boomers right now. We have 401k accounts. It sure seems like to me that if boomers are still actively engaged in investing, to have such concentrated portfolios right now, instinctively, gut feel, people should be thinking, uh-oh, this doesn't feel right. There's got to be a way, okay, I could take my chips off the table, but what if things go higher? You got FOMO, all that kind of stuff. But when you get in these situations, the fear of missing out on Bitcoin going to 1 million has got a stranglehold on people more than it going back to 5,000 or 10,000. There's like a risk reward problem here. And maybe risk is the word we should open it up with, but properly assessing risk in moments like right now seems to be out the door for a lot of people. Of course, there's plenty to do, but for a lot of people, assessing risk is not at the top of their thought process.
No, absolutely. I think FOMO is a good point to make. I have a couple friends there in their late 80s that are maintaining their Apple positions. They're maintaining some of their tech stock positions. They don't need to. I've had the question to them. I said, what happens if you double your money now? He said, well, it doesn't change anything. Okay, what happens if you lose half your money? Well, that would be terrible. That simple discussion should just pop in their brain going, oh, yeah, what the hell? But they're in the game. I think 3 things that I would describe that are making that happen. FOMO is one. They don't want to miss out if it doubles again. The other is that they are in love. That position is part of their personality. It's not just that they hold NVIDIA or they hold Tesla or they hold Apple. That is part of their personality. They've been watching that stock for years. They watch TV. They talk about the stock. They'll have it at their lunch with some of their friends. It's part of their personality. They can't abandon that any more than they can change their personality. The third, depending on the account that it's in, but in a lot of cases, it's tax. This is sort of the rationalization is that, well, I can't sell it now. I'll have to pay this tax on it. It's better I just hold it. That helps rationalize those first 2 decision points that I made of FOMO and it being part of their personality, part of their psyche. You see, this is a time when there should be some liquidation or profit taking in some of these stocks by the baby boomers and the retirees. And you're not seeing that. They're still in the, and I'll put it in quotes, the game.
So you bring up a great example of like getting somebody of a certain age, frankly, any age, to think about, okay, if things double, great. But if things get halved, is that so great? No. Okay. So then the real issue becomes is how does that particular individual, you and I are kind of talking like we're in a college class or talking with a bunch of people. They might not have the experience. That's fine, whatever. But if you've got somebody who's listening and they hear you, Mike, say that, okay, doubling, that's great. But halving, that's not so great. And they might not even know to use the word risk. And if they do use the word risk, they might not know how to quantify it. They might not know how to structure in their mind that's how to handle it. You've just given a simple heuristic to think about it, especially at a certain age. But how would you bring people into the discussion of assessing risk?
In the end, it gets down to their lives and what they're trying to accomplish in their lives. Risk goes across so many things. Financial is just one aspect of it in someone's life. I do find those heuristics being helpful. I've used them with people that are looking to lock in a mortgage rate. The same thing. Rates are coming down and I could wait and it's okay. If you could get it at 3.5 instead of 4, how's that feel? What if it went to 4.5 instead of 4? Giving them an opportunity to kind of at least try to put themselves in that position because the markets are somewhat random in the end. It's not that they have a real call that interest rates going down and they're going to get a better rate. They might think that they have that predictive capability, but they really don't. So I don't really have an easy way to get people to, I can't do it myself, get myself to think in a totally rational way. I've got to use a process. I've got to use a systematic process to be able to do that. Otherwise, I'll constantly be second guessing and trying to project what I think is going to occur based on just these little pieces of knowledge that I have that are always incomplete.
Let me take you back in time a little bit. Even though you're a very youthful guy, you've got many decades of experience at this game. You've had a chance to know some of the superstars in the industry, so to speak, and up close and personal, and have many conversations going back a long period of time. How the hell did all of you guys, a lot of trend following people that I've talked to on this podcast, people in my books, how did you guys all get this right so early in your careers? And the thing that I always observe too is that it almost seemed to be random. If I went to one of these FIA events or MFA events back in the day, like if I really did some polling and stuff, it's like you guys didn't all like grow up with each other. You were in different cities, different backgrounds, but somehow or another, there was a calling that got a significant number of quote early pioneers to the same place at the same time, which is fascinating. Maybe the world was smaller in a way then. So if somebody had a little bit of an alternative or contrarian perspective, maybe the alternatives and the contrarians ended up at the same place. But I always found that very interesting that you and many other, again, like-minded peers found this way to understand human nature, the psychology of man at a very early age.
Yeah, so our approach is a little different than Jerry Parker or John Henry had or Bill Don in the sense that we've always believed that you want to have a quantitative, not always, I guess, for the last 30 years, a quantitative approach to markets, but they didn't necessarily have to be limited to just quantitative trend following. That there are some markets where there may be other factors, seasonal factors, or things that come into play that can be exploited as well over time. There's also multiple ways to potentially capture what trend following is trying to capture, which is just sort of psychological move that occurs in markets. We have strategies that actually look at money flows, try to determine psychological moves. What are people really doing with their money in the markets? I've been reinforced over and over that when I try to second guess those systematic processes and think, okay, this time I've got something uncovering that's different, it's almost always led me wrong. Just like people that get reinforced when behavior of buying the dip continues to work, and the dips get shorter and shorter, and the subsequent moves get bigger and bigger, reinforce that that's the right move for them to be making. I've been reinforced that me trying to second guess the systematic approaches that we put in place are the wrong thing because ultimately it costs me.
We've got many different approaches to try to harness the inefficiencies of the human mind, right? I guess my point still goes that even if your approach was different, it was still in the same headspace and you were still trying to tackle the same problems, which is I really can't predict tomorrow. I know I'm Homo sapien. I know I've got fear and greed. There's FOMO. You know, all these psychological quote biases or defects that we have. So again, how do you think back in the day, or is it the same thing today that just even a young person today, different tools to find people today? I should clarify for people listening that are in their 20s or 30s or something, Mike did not have access to a digital phone in the 1980s to just surf around and connect with people. So there was a much different process to find information. It was more print materials or a magazine article. It was much different process. Now, this all changed in the 90s, but is quite a different process to find yourself in a place to where you knew you needed these systematic processes. Find other like-minded people that were thinking something similar.
Right. So this is the early 1980s. I was sitting in my parents' house in a room trying to turn what I was doing from trading that started in 1979, trading in options, into a business. My dad, who was a conveyor salesman, came into the room and he said, "Aren't there any conferences or something you can go to? I really feel like the only way you can get into a business," this is him finally capitulating and was serious about turning this into a career instead of getting a quote real job, right? His comment was, you really need to see people face to face. Till you talk to people, you meet people, you're really not part of the business. And that really triggered. So I had been talking to people on the phone. I called around to the people that were out there, the Campbell brothers and Bill Dunn and stuff that had been around for almost a decade at that point already. I found out about managed account reports, and they had these conferences twice a year, usually one in the winter, one in the summer. I signed up to go to the next conference. It was in Chicago. We had maybe 190 to 100 people at that conference. So all those early pioneers I just mentioned, and then John Henry's first conference was there when I was there for that first conference. You started meeting people. That was how you did it. There wasn't the internet and there wasn't this podcasts that were available to listen to. It was either on the phone with somebody or face to face. There was that early group But in that time, commodity trading advisors that were thinking different. The people in the equity markets weren't. They were still very much stuck in the way they had been doing things for the last 20 years. But the commodity trading advisors were really out there starting to understand what risk meant. Not that we all followed it or developed the right techniques to control it or manage it. They were at least looking at risk and diversification across different markets and portfolios and coming up with different approaches for trading those markets.
I was coming along later than you to try to gather information because I was fascinated by this. Was it Sol Waxman that had it?
Yeah, so actually, sure.
Yeah. He actually, for my second book, he provided something quite interesting, which was the monthly returns of the turtles under Dennis while they traded for Dennis, which I did not know existed. And he was the one that turned that up. Oh my gosh, I tried like crazy through Leon and his wife before he passed. I tried like crazy to find if there was a box of tapes somewhere from all of those events that you guys had in the 80s. Because I was guessing, I was like, oh my gosh, the freewheeling conversations, the insights that you guys must have all been sharing. I got a lot of them in the 90s, but I was looking for that to turn up those cassette tapes that got lost to history. People don't understand how crazy it is, how much information and sharing that took place that did not get recorded.
Everything wasn't recorded then like it is today. The conferences, they did often have somebody recording the actual sessions. I may have tapes, but I don't know if they go back to the 80s actually either. But yeah, I had dinner with Joy and Leon Rose probably now 15 years ago after one of the conferences where they received one of the lifetime achievement type awards. They were the first recipient of it. We went out to dinner after that. And I remember thinking at the time, the industry had already changed so substantially. The people at that conference, they know these people were getting the award, but they didn't really understand that the extent that they shaped that industry and created what these people were then participating in. But it went from true Wild West to an industry over about a 15-year period. And they had a lot to do with that.
I did find a lot of those original old, I mean, old now, not old then, but MAR reports where they would feature a bio of somebody, their performance at the time, explanation of their technique. Don Sheehan was in there and stuff like that. It was just fascinating. I found the whole process of finding information from the 70s and 80s that then built on what was coming out in the 90s, which then built on what just kept coming out for the last 25 years. I don't know how many young investors think about it. I think there's so much of what you hinted at in this conversation where people, they get some performance, they get some gains, and then the ego starts to flex and they think, I'm responsible for all that. Whereas you can find, if you really do some digging, you can find this kind of network that has gone on for decades and decades and decades where essentially wisdom got passed down. And it's really cool, frankly, you know?
Yeah. Yeah. It was an interesting group back then of people that were independent. Everybody's trying to make their own way and beat the market, but it was very collegial. Everybody was in it together, even though we were competing with each other. It was an interesting time that way. People wanted to do well on their own, but they wanted the others to do well as well. There were some people that you kind of wished ill on maybe a little bit. For the most part, everybody was supportive of each other. And it was nice. It was an interesting period.
Let me take it back to the risk point that I brought up. Where do you try to take people? I mean, look, you've got your firm, you've got your thought process, you've got your strategies at Brandywine. How do you want to conceptually, philosophically bring somebody in? Let's say right now, somebody, they've got their essentially following an index, they've got that kind of standard type equity investment, and it's not protected. It's at risk, the whole risk we've been talking about this conversation. They got the NVIDIA or they've got the index and it's long only. If things could turn around and go the other way, they're going to retrace, right? We talked about it before on the podcast, but I want to remind people, what's your thought process of trying to bring people into a strategy to prevent that from happening?
We really boil it down to one simple statement that reduced loss equals increased returns. If over time you can control the downside so that instead of dropping 50%, you're dropping 25%, you're recovering from a higher level, you can increase the slope of your returns, not in spite of the fact that you've taken less risk, but because you've taken less risk in that portfolio. That simple concept, reduce loss equals increased returns, really drives everything that we're doing today. We've got a suite of 14 funds that are designed for 401k plans and a hedge fund that's all based on that philosophy. If you can do that, you can sleep better at night and you can end up with more money when you retire.
Well, there's a simple math there too. Sometimes people don't think about this. And for example, some very aggressive trend following traders, many of which I know have taken 50% drawdowns, but they trade very hot. And many of them have brought it back and made a lot bigger gains. There's a strategy to that thinking. However, for the average person that might not want, let's say they're a little bit older, they might not want that kind of volatility in return. It's worth reminding people that if you drop 50%, if you're at 100, and you go to 50, to get back to 100 is not a gain of 50%. It's a gain of 100%.
That's right. So the whole idea is minimizing those drawdown periods, those bear market periods, so that you can recover from that higher plateau. If you can do that and maintain reasonable performance in a bull market, you don't even need to match the performance to outperform over time. But if you can structure a portfolio that has the ability of matching that performance in a bull market, but constrain losses on the downside, you can really compound returns over time and do it in a way that's a lot easier to live with than riding through a 70% or 80%, some of these high tech funds losses that we had in the 2022 bear market.
Give people some insight into your process. You've got clients 100% long position, benchmark index, but you don't want to have that downside. What is your approach to prevent the downside, or to try to prevent? There's no guarantees in life, but to try to prevent that downside and mitigate the potential of loss.
Sure. It's a synthesis of what we've been doing for the last 40 plus years. It's one of those things that when I discuss it with people, a lot of times the investor will go, that's so logical. That's so simple. Why isn't everybody doing this? One of the examples I give to that, and I'll explain our process in a second, is with the show Jeopardy, which I don't watch a lot, but James Holzhauser is a guy that went on to Jeopardy after 50 years of the show of people picking the lowest price category, $100 or $200, and working their way up. He started at the top. He started with the highest price reward. The whole purpose was at some point you hit a daily double in that, and he would hit that daily double with more money in pocket to bet than if he had started at the lowest ones. He had the skill set to answer all the questions. If you have the skill set, you might as well start with the question that's going to pay you the highest reward. Because of that, he ended up with the highest average per game winnings of anybody in the history of Jeopardy. Now you see a lot of people doing that. But for 50 years, nobody did that. They all did it the same old way. This is one of those processes where I'll describe it and people go, oh yeah, why hasn't everybody been doing that? It's pretty straightforward. It's three constituents in a process we call risk replacement. You start out with the benchmark underlying index. So in our Brandywine large cap, you own the Russell 1000 or S&P 500. They have a 99.8 correlation. Either one is fine. You buy put option protection on a portion of that portfolio. It could be 100%. It could be more than 100% if you want. But in our portfolios, we generally have about 40, 50% put option protection on there. So we maintain still a fairly high correlation to the underlying benchmark. So people can just swap out an index fund in the S&P 500 with our fund, for example, get similar returns over time. And then we attempt to pay for the cost of that put protection by doing what we've been doing for the last 40 years, which is think of it as an overlay strategy that invests in a broadly diversified portfolio, globally diversified across strategies and markets. It's essentially what modern portfolio theory says you should be doing anyway, diversifying the portfolio. It's structured to pay, say, 2.5% to pay for the cost of that put protection every year. It's not structured to pay for 10% that the underlying index might be intended to make. It's a fraction of that. It's more broadly diversified. What you end up with is the underlying benchmark performance that's offset by the put protection and then replaced by the performance of this return driver diversifier, as we refer to it, this broadly diversified portfolio. But it's replacing the high risk with this much lower risk using a combination of put protection and this diversified portfolio that's in there. You can do that by using futures to give 100% exposure to that underlying benchmark. Usually about 80% of that might be actually invested in an ETF or some cash index. The other 20%, you take a few percent of your cash to margin of futures position to give you that other 20% exposure. You still maintain 100% exposure to the underlying index, but now with protection on the downside.
Invariably, and this often happens if I'm having a discussion with somebody about trend following, but people will hear about a particular strategy that sounds very practical, very well thought out. And their thought will be, well, what if everybody does that? Then it's not going to be valuable. And the thing is, what you just described, if anyone just uses some basic common sense, the vast majority of investors are not going to do this, right? The vast majority of investors is not my problem or your problem. Our problems are our problems or our friends' problems or our clients' problems and our close networks of problems. The world's problems are not our problems. It's one way to think, where sometimes people get a little too fixated on the philosophy of what if everyone? Well, what if everyone's not going to happen? Why don't you just think about yourself for a second?
No question. There's just an article in the Wall Street Journal. At the end of the article, they quote me in there talking about what we're doing with this protection. The article states, although we see the approach is intriguing, it can't be applied to the trillions of dollars across the board in the retirement industry. My comment on that is, of course it can, but it can be applied to your portfolio or your client portfolio today. 5 years from now, maybe not. Maybe we're at a capacity level that we can't continue to apply this, but that doesn't matter. All that matters is whoever I'm talking to at that point in time, you have the ability of doing this today. You're very right about that. This isn't something that everybody can do. I'm not talking to everybody. I'm just talking to the people I'm talking with today who do have the opportunity today to do this.
With that article, the reporter, I think what they're also driving at too, it's sort of like, well, Mike, I'll believe you when everyone does it. This isn't, I can't really believe my lying eyes. I can't really take the risk to be different. I have to stay inside the crowd. I have to be long only NVIDIA and every other tech stock right now because everyone else is doing it.
Yeah, absolutely. I wrote about this over a decade ago in my book, is people don't measure risk by how you and I might look at a risk. What is the probability that we don't meet our monetary goals? Or what's the probability that we have a risk of ruin at a certain level? They view it as how different they are from other people. The majority of investors, not just individuals, but primarily institutional and professional investors, they view risk as how they deviate from what everybody else is doing. The more they deviate, the more risk they're taking. It's defined as career risk rather than actual financial risk. It's exactly what is right here. Is there are certain people who will look at it and they have the ability on their own to evaluate and say, you know what, this makes a lot of sense. I get it. I'm going to do this. The majority of people who will say, well, Vanguard hasn't rolled this out yet. Why is it so good? I can't believe it really works. It can't work if they're not doing it. And they avoid it.
You make a great point too about comparing to the relative aspects of, let's say, a loss. So many, quote, fund managers or funds or traders or whatever, if things are going down, they don't say, well, I went down XYZ%. They say, well, my neighbor went down this amount of percent and I was pretty close to him. That's their measurement. Dishonest is one word you could say. It's psychotic to look at the world that way. Well, I came close to dying, so we both came close. It's all very strange.
It's self-preservation of the financial advisor industry in some extent. These people making a lot of money, telling people where to put their money. Some of them try to have a gimmick, a trick, a little market timing thing or asset allocation process that they follow. But we know that doesn't work for long for most of them. They have a period where they called the financial crisis and they get $1 billion flowing into them because they were smart to call that. And then for the next decade, they underperform because they got lucky, right? That's what happened. They've continued to preach that you just sort of buy and hold and the market's down. There's nothing you can do about that. The market is down. And they've gotten people sort of trained now that you never get out of just holding these static long positions. Yeah, you're going to suffer through it, but so is everybody else. That's just part of what happens. As long as you have short-lived bear market drawdowns and the market recovers to new highs in 12, 16 months, whatever it is, that behavior is reinforced.
I'm not going to try to take you down this path, but as you lay that out, a lot of investors don't go back and look at history, but if they want to think there's always a quick bounce back, all you have to do is go look at the 1970s.
Some people might say, well, that was a long time ago. That doesn't count. Yes, I'm not trying to say things are going to unfold exactly, but be prepared for the potentiality of whatever. We don't know what's going to happen. We just don't know.
That's the other thing, is that you can take the U.S. history over the last 125 years, which I did in my book. You can extrapolate that out and say, well, of course, you just keep on. It always works. My point isn't that I'm disputing that. I don't know, is my point. There are studies, and I have those in there, that talk about, of the 40, 36, 40, whatever markets that were existing at the beginning of the 9th century, the 20th century, the end of the 1900s, only 4 of those continued, but to the end of that century with uninterrupted active markets. The rest of them had just either massive disruption periods or they just went out. They disappeared. I'm not saying that's going to happen in the US. I'm just saying, why would you not at least have some preparation in case something dramatic happens? We're in pretty unusual times right now in this country. Almost anything can happen. We've seen it. Turns can happen quickly. Again, I'm not saying it's going to happen. I'm just saying that if you can get the same results if it's bad as if it's good, why not take the approach that gives you those results if it's bad as well? That's available today. People don't take advantage of it because they just extrapolate forward. You only have to look back to the 2000s. You don't have to go back to the 1970s either.
It was just a handful of years ago. Time flies, but Michael, I appreciate the time today. Always fun chatting. Hey, where can we send people? I believe it's brandywine.com, right?
Sure. It's just brandywine.com. This is where they can learn a little more about what we do.
We should at least try to catch them every couple of years. From our first conversation until our second one, I think there was a long gap.
I do want to congratulate you on the podcast. I'm honored because I was your first podcast over a decade ago. You've done a phenomenal job. You've got some great podcasts out there. You've interviewed the top people that invest in minds over the years.
I tell you what, though, it's fun. Michael, let's talk again soon. I appreciate it. Again, brandywine.com for those curious to go check Mike out.
Great. Thanks a lot, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.